Roses are red, violets are blue, fund managers underperform, and so will you. Welcome back to the channel. I'm Foreman, and today I'm going to be talking about funds, in particular actively managed funds, but I'm also going to speak more about index funds as well. As when I'm talking about funds today, I do mean it in a very broad manner. I mean the sole argument of investing either in individual stocks you've chosen yourself or investing in funds, be it actively managed or not. I'm also going to talk about the motivations behind a fund manager and why I think they're more likely to underperform than perhaps the usual or more due diligenced private investor. And if you like the video, please drop one of these to help beat that YouTube algorithm. I could be on about the FTSE All World ETF, which would have been a passive global tracker, or I could be on about Fundsmith Equity, which is an actively managed fund, or I even could be talking about specific niche investment trusts like Scottish Mortgage Trust. The idea, the concept as a whole is what I'm really trying to talk about today, because I frequently get comments about it. As you will already likely know, I am underperforming the markets, and yes, by quite a significant margin. My stock picks have not come to fruition yet. It is still a very short-term time horizon, and so it's understandable, at least in my opinion, or perhaps I'm in denial, that I am underperforming for now. However, that doesn't stop comments from coming in, and these comments will say, well, if a majority of fund managers underperform, you're going to underperform too. The odds are stacked against you. However, I don't like this because this feels defeatist to me, because it's basically the idea behind it, and the people that would mention this are like, look, if you can't beat the funds, just buy them. But then how are you ever going to beat them? You're just giving up before trying. And so in my perspective, I want to try to beat them. And I think they do have a lot of disadvantages against them. And so there is an advantage, or there is a place for private investors to do well. And I want to talk about what is the motivation. What motivation does a fund manager have versus that of a private investor? For myself, I'm personally motivated to increase my level of wealth so that in the future I may retire or at least have financial independence at a much earlier stage. Whereas a fund manager may be motivated to make money as well. They may be looking towards increasing their salary, because after all, they are paid by these funds. And sure, some of these funds do get increased, some of these fund managers would get increased payments if their fund has a better performance. However, I do think there's less of them involved in it. And when I say that, I mean, when you're a private investor, you're investing everything of what you have. I don't mean necessarily all of your net worth, but you're investing all of your money. Whereas for instance, fund manager isn't necessarily investing their money. They, for instance, might have a very small stake in the fund, but ultimately they aren't using their own money for investments, they're using other people's. And so there's less of an emotional attachment, which could be an advantage and a disadvantage, because an emotional attachment could mean that you're underperforming because you don't want to sell a stock because you've held it for so long. But at the same time, it could be a massive disadvantage because you could be much more careless. You could be frequently making trades that aren't really providing much value over pure emotion, or not. But I just assume that if I'm not managing my own money, can I really trust others to do the same? Are they really going to put the same level of effort and care that I personally would be looking to do? If you're content or happy with other people managing your money and you know that they're going to do more than you would, then that makes complete sense. Of course, invest in those fund managers. However, if you're someone that is very active in your money management and you're someone that really wants to put a lot of care and detail into it, then surely you would be better off trusting yourself, or at least doing as much research as physically possible to therefore sustain your beliefs. Which then does give you an advantage, because these index funds, these global trackers that aren't actually actively managed, but they do rebalance every few quarters per se, these could become a much better option. And that's because these global trackers aren't actively managed. There isn't a fund managed to go to, and usually these are tethered to the indexes, and these indexes are a large conglomerate of all of the biggest companies in a given geographical location, and that could be advantageous. However, I see it as more of a disadvantage, and that's because with global trackers, you're pretty much buying into everything, and I think a lot of investments aren't that great, or at least aren't great in my opinion. This is because if we look somewhere like in the FTSE 100, a majority of that index is held up in these old world stocks that I don't think are very high quality, at least for growth. And that's because they are already very globally diverse companies. They're not really going to be growing on share price. It's not going to be appreciating by large amounts, at least enough for me to grow my portfolio. And so I feel that indexes just wouldn't be for me. But the beauty with index funds is that you can choose specifically what industries or what geographical locations to invest in. For instance, I might be interested in the developed world, but I might think UK is set to underperform. I could then get a developed world or ex-UK fund, which effectively means that I'm invested in all of the developed worlds except the UK because I have a bias against them. This is not true, by the way, but I'm just mentioning it for example. This could also be an effective way of global diversification. You might want to create or replicate an all-world fund, and so you might have a 90% allocation in the FTSE All-World Developed ETF X UK and also 10% emerging markets, and then if you pick your own individual stocks in the UK, that would effectively, at least in my opinion, globally diversify my portfolio. But the trouble is these index funds, they are heavily weighted in companies that have already seen a lot of the growth. After all, they're invested in the biggest businesses. And this doesn't necessarily mean they're going to fail because, yeah, they are big businesses. They're so globally diverse and so cash generative that they are unlikely to fail at this point, although they do have their own set of unique problems, such as if we look towards more of America with the FANG type stocks and investments like Amazon. When does regulation come into play, and when would they start to be split up, for instance? And that's why I prefer personally to find my own quality stocks. I don't trust these index funds. I don't really trust the active fund managers because I'm not quite so sure what they're investing in. And I know that there's limitations. I would say a lot of the growth is in small and micro cap stocks, which are stocks of a very small market capitalization. Micro cap is more on the riskier side. I believe small cap is less than £1 billion. This in turn means that if funds were to invest in these stocks, they wouldn't get an effective return on investment because these funds are worth billions and billions of pounds. Them investing 0.05% of their capital into a company because there are legal regulations in place preventing them from putting too large of a stake means that even if the stock doubles, triples, or 10 times multi-bags, it's really not going to give much of a return to their overall portfolio performance. And so they have to look up the train. They have to look into these bigger companies, the mid caps, the large caps, and that would explain why in a lot of these situations, these bigger funds are invested in some of the biggest companies in the world, which is where I think there is a large limitation because these smaller micro caps, this means they are much more under-researched. There's an advantage here for the private investor because the private investor, providing they're not a high net worth individual, they can invest pretty much all of their net worth, 100% of their net worth, into these small micro cap stocks that might do amazing over the future, whereas the funds can't do this. These private investors can generate a much more effective return on investment, assuming that they've done their due diligence on these companies and have visions as to why they will do well in the future. As such, it would be the idea of buying into these stocks before the funds are aware of them, and then when they grow into size, the funds will start buying in and give a constant upward pressure on the share price. It's basically saying the more that you encompass everything, and we're going back to index funds here, globally tracking, what you do is you lower the average. You bring everything into this average, and overall it lowers it because you've got every single big company and their growth is going to be a lot lower. Whereas if you really slim down and you really narrow down the high quality stocks, these stocks could be growing by a lot more, and this could be a better driver of share price and could be more of an effective investing strategy, although this isn't proven by myself because as of right now, I am underperforming the markets. Although arguably the most powerful benefit of a fund, actively or passively managed, is that you, the individual investing in this fund, really don't have to do much work. Either the fund managers or the indexes that are just being globally tracked are doing the work for you. They've already invested in all of these big companies. They're already globally diverse, at least in some cases, or diversified adequately. This means that if you haven't got the time or you don't really want to put the effort into learning about the stock market and the complexities around it, then this sounds like such a brilliant idea because yes, you can invest your capital into an index fund, know that it is likely in safe hands, and continue to pump money into it. Then you can focus your life on other priorities. You might believe that your mental and physical health is a better priority, and so you might be going to the gym. Instead of researching stocks in that time, you might be prioritizing fitness. This is just one obscure example, but I hope that may relate to some individuals that are watching this. Myself, I can see the beauty of this. This passive investing nature would be something that I could very much appreciate. After all, my mental health is likely deteriorating. It's better now, but I'm getting high levels of stress. In my sleep, I'm actually grinding my teeth, and I'm getting into a point where my hands are shaking a lot. The camera's not really picking it up, and it was terrible yesterday. But I digress. I believe it's my stock market investments. And so if I was invested in index funds, for example, I think the stress would be taken out of it, especially because, as I mentioned earlier, that average, all of these companies combined, is going to lower the volatility. This volatility means subsequently less risk. So yes, the risk to reward ratio can be lower. But then the beauty of these passive investments is you can invest in these specific funds that perhaps focus on small cap, high growth pharmaceutical businesses. And there is those advantages there, but I would rather narrow it down further and pick my own if I understood that sector. However, yeah, if you didn't understand these specific sectors, but you wanted diversification into them, then that wouldn't be a bad idea in my opinion. The trouble is with myself and the channel, it means that if I gave up, I stopped investing in individual stocks, and I started to buy index funds and actively manage funds, my channel probably won't do too well. That's because I would start to find it boring. I think everyone else would get tired after a while. Sure, I could jump back to the basics of investing, but eventually you get those points across. And once you get there, that's about it really. And it becomes much more difficult to really keep an audience interested on such a basic level of information. And you may have noticed, this is why I stopped doing the stock analysis series, because the stock analysis, those stocks I really weren't interested in were starting to bore me. I had no interest for stocks that I was never likely going to hold in the first place, and so it really burnt me out trying to create those videos. The same thing would happen with index funds, for me at least, and so the channel itself would likely drop off. I would have to stop creating businesses, and I would likely have to lay it to rest. And that's why, in my opinion, I'm very unlikely to stop picking individual stocks, unless of course the channel had stagnated and declined for other reasons. And so for myself, it means I'm likely going to continue picking individual stocks. Almost in a similar method, I avoid US stocks because I'm not interested in them. Everyone's like, you should go to US markets, they're providing better returns because they're more volatile, or their companies are higher quality. I'm not interested in that. I don't care about these US companies because I'm in the UK. I want to see which UK companies are doing well. Yes, I could invest in companies with global diversification. Yes, these companies are exposed to the US, but I'm primarily interested in the UK, and I will keep investing here. Whilst with the time acquired from having index or passive funds, I could likely invest in my own health. I could likely spend time doing elsewhere. It would effectively mean that my stream or hope for passive income in the future, being the YouTube channel, would likely die down. I feel that active managers are likely primed to underperform the markets because they have no true motivations to beat it. They may be ambitious individuals, but after all, it's not really their capital that they're managing, and so why would they want to grow it as extreme amounts as a private investor is willing to go? After all, they've got a secure salary. They may get removed from the position, but they've still got that money. Whereas a private investor is risking their own capital, and that provides a level of, let's say, more trust that I would put in myself than I would in an active manager. I will admit this video was much of a ramble because I did try scripting this, but I just couldn't focus. So I tried to get all the information relevant. I probably missed out so many points. But if you are interested in my free UK stocks to buy in July, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a great day.